in Kenya, emerging trends, opportunities, and predictions for 2022 and beyond. We'll be joined by the speaker, Mr. Raphael Muito, to take us through that discourse. Mr. Raphael Muito is the Development Director at Property Geometrics Limited. Allow me to share my screen so that I take us through the program. The program for this afternoon's webinar will start off with the opening remarks and introduction of the speaker by Dr. Murithi Ndegwa. After I'm done with the opening address, then after the segment by Dr. Murithi Ndegwa, ED and CEO at KIM, we will have the keynote address by Mr. Raphael Muito, Development Director, Property Geometrics Limited. Members, you're free to type in your questions into the chat box as we prepare to go into the question and answer session after the presentation by Mr. Raphael Muito. Then after the question and answer session, we will proceed to have the closing remarks from Dr. Murithi Ndegwa, ED and CEO at KIM. At this point, allow me to welcome Dr. Murithi Ndegwa to give us his opening remarks. Karibu, ED.
Thank you very much, Brian. Good afternoon, everyone, and welcome to this week's webinar. As Brian has said, the topic is quite interesting. It's about making money from real estate in Kenya. And Mr. Raphael Muito is going to be talking to us in terms of emerging trends, opportunities, predictions, and so on and so forth. But before I invite our speaker, allow me just to make a few remarks. One is to set the pace in terms of what our perspectives are in regard to the topic of today. Very often we've seen images of and pamphlets of billboards, written plots for sale, as well as high-rise buildings with a sign to let. And this is a very common phenomenon in the mindset of the Kenyan populace. But even before the term real estate became popular, in our view, there's always been that aspect of real estate is regarded as a high return investment. And this is whether one buys land for resale or to build rentals. Indeed, real estate as an investment also seems like a well that is not about to run dry. And according to Habitat for Humanity, we are told that Kenya has an annual housing demand of 250,000 units with an estimated supply of 50,000 units, meaning a housing deficit of 200,000 units or 80% deficit. Now that obviously means that there's a lot of room for investment. So in our considered view, real estate is lucrative, but before you invest in it, it's our view that it is best to have the information that you need, because just as there are success stories, there are also painful stories, from buying fraudulently acquired land to contractors misappropriating the money to building substandard structures, etc., etc. Indeed, it reminds me of a story that is told of a diaspora investor who kept on sending money to somebody locally, and this person kept on taking photographs of different buildings at different stages to show that the investment was happening. So when the diasporan guy came, he found there was nothing that had been done. And these are stories that we keep hearing in the marketplace. Additionally, worth noting is that the fact that the aspect of ever appreciating asset was completely shaken by COVID, and none of us saw it coming. We remember cases of where property owners had to do the previously unthinkable thing of bringing down rent charges and even forfeiting rental income for months as tenants were stuck with arrears and opted to move out. Indeed, there was one case in the social media where there was one tenant who actually gave a rent moratorium, and it was something that was completely unheard of. So whether it's for resale, development, or just to settle your family, the fact that real estate was contributing 9.1% to Kenya's GDP by the year 2020 is clearly an indicator that it is a rich sector. But the question therefore is, how do we make the best out of it? And this is the reason why we've invited Mr. Raphael Muito, who is the Development Director at Property Geometrics Limited, who will give us insights that will give us the knowledge to create wealth. Allow me to give you a quote, and this is from none other than the late President of South Africa, the late President Nelson Mandela. And he says, and I quote, "Money won't create success. The freedom to make it will," end of quote. Finally, just some brief highlights on KIM activities. We still continue to appeal to you members to renew your membership for 2022, and we encourage you to be up to date. You can do so by paying through paybill number 896-600, or you can call us on 0712-200-969, or email membership@kim.ac.ke, and we'll endeavor to give you the details in terms of what you need to do to renew your membership. Alternatively, you can call the membership officer, Mr. Jeremiah Wanga, and his details, telephone number 0703-840-345 will be posted on the chat so that you can interact with us. Secondly, KIMSOM, that is the Kim Institute of Management programs, are ongoing. We request you to register for your diploma or certification courses in all our branches. If you need any further details, please post your details on the chat and we'll endeavor to respond. We have some upcoming programs in training and consultancy. Some of them are supervisory skills management, which is running from 15th to 19th of August. We have stress management and conflict resolution training, which is running from 22nd to 26th of August. We have management and leadership skills program for executive secretaries and admin assistants. Again, also running from 22nd to 26th of August. For more information, please contact us through the telephone number 0773-359-278, or send us an email at training@kim.ac.ke, or please post the details on the chat and we'll endeavor to respond. For more details about Kim products, you can also visit our website, www.kim.ac.ke. But since we are all members and we are all present, please post the details on the chat and we'll endeavor to respond to you. Without further ado, let me now invite our speaker. Our speaker is none other than Mr. Raphael Muito. And if Brian, you can kindly post his details, the bio data on the chat, on the screen, I will take the members through. Right, Mr. Raphael Muito is the Development Director, Property Geometrics Limited. Raphael Muito is an established real estate expert focusing both on development and investment. He has 18 years experience, initially practicing as an architect and thereafter as an investment manager in charge of real estate, and then as a development manager advising largely institutional clients and undertaking various investments into real estate. He worked with the Stanley, which is a South African asset management company affiliated with Stanbic, as an investment manager, then as a development manager with MML, then as Artis Investee Company, but now Turner and Townsend, and then with Britain Properties as head of business development and head of property services. In his various capacities, Raphael has advised management investments on behalf of clients totaling to well over $1 billion US. That's a huge amount of money. Some of the developments he has advised on include the Archdiocese of Nairobi basement parking at Holy Family Basilica, which is really a very, very nice project. Housing projects in Nakuru, Kisumu, and Nairobi for varied institutional developers. Brigham Tower, which is again also a masterpiece, and Ascot Somerset Westview in Kilimani, branded service apartments for Britain. Currently, Raphael is advising on several projects, including a campus headquarters for major corporates in Kenya, a mixed-use development in Douala in Cameroon, structuring small to mid-sized syndicated projects for investment purposes, and looking to create returns that are above comparable assets in the market. He has also worked on multiple highest and best use analysis and feasibility studies on behalf of many clients. Ladies and gentlemen, let's put our hands together for Raphael Muito. Raphael, the floor is yours. And as usual, like we always say, members, if all is well, please give us a thumbs up. If there's a problem, give us a thumbs down, or post the details on the chat and we'll endeavor to respond to you. Raphael, the floor is yours. Please give us a discourse on the topic of today. And thank you very much, members, once again for coming on board. We are now all ready for you, Raphael. Thank you.
Okay, thank you, Dr. For this very warm welcome. I'm so glad to be joining you this day to take you through this webinar. I'm so passionate about real estate generally, and I know real estate is it's one of those topics, one of those areas that a lot of us are just too eager to listen in to learn, and I hope the next 45 minutes to 1 hour will be worthwhile, will be worth your time. And I know I can't do justice to the whole topic. It's actually quite wide. So will you allow me to share the screen, my screen first, and yeah, so the topic I was asked to share on is the making money from real estate in Kenya, and just looking at emerging trends, opportunities, as well as predictions for 2022 and beyond, especially given where we are as a country. And it's a very wide topic. When I was actually thinking through it, I realized, because I've trained on specific components of this topic before, and some of them actually can be done even on their own, in a webinar on their own. So I wanted to just quickly start with just a number of macros. This information, it's a piece of statistics. Yeah, so this is statistics coming off from Kenya National Bureau of Statistics and others. And I just wanted to ask ourselves where we are as a country in this sector. And so I looked at cement production up to now, 2022, and you've seen it's been growing. Actually, this has been, the trend has been up since President Kibaki came into power in 2002. The cement production has been increasing. And actually, if you look at the other graph, the inverse, which is cement consumption, it's also been increasing. However, when I wanted to compare this data with what's happening, especially in the real estate space itself, and I looked at what we call the value of building permits up to now that have been approved, the strange thing is that since 2014, 2015, actually the value has been dropping. The trend has been really a continuous drop, but it accelerated since 2016. And so there is a big disconnect here where you have cement production, which should be telling us there's a lot of activity in the construction sector, increasing and actually being consumed. But then if you look at what's been approved and where you expect this cement to go, that has been dropping over time. Something that will come out of this is that if you look at construction industry, there is a lot of the public investments in construction. So the roads, the dams, all the infrastructure that is being done. And then of course, there's a lot of the private sector component, which is now a lot of the buildings and the real estate component. So you'll find actually the real estate component has not been doing well. A lot of the cement that has been produced has been going towards public infrastructure projects. And so when you look at that, there's that disconnect, and I think you're feeling it, even you're feeling it in the market. We are seeing a slowdown in the market. You're seeing a lot of abandoned projects and all that. These are not helped by what's happening globally on prices. Now, if you look at the last 2 years, for example, the cost of steel has doubled. Well, it's coming off slightly since June this year, actually May, June this year, after it had gone up quite significantly, January, February, March. But really, the last 2 years, steel, which is a major component of most of the projects we undertake, has been going up internationally. And this just mirrors what's happening across most of the low-cost components for real estate. If you look at cement, which was at about 500 shillings sometimes last year, we're talking about 650 to 750, depending on which part of the country you are in. So we're looking at a sustained increment in costs, such that all of a sudden, for a lot of people, even people building their own houses, the question is, are we able to actually complete our projects? Are there alternatives? And we'll probably just quickly go through later on as I close the alternative building technologies that are there, and we'll see whether you want to adopt them or not. Now, but given all this, if you're looking at really our demographic profile as a country, we're saying below 25 years, there are almost 15 million people. And all these people definitely will need some form of accommodation. They will need to work from some place. They will need to go to schools. They will need to go to hospitals. And the question is, do we have all this? Do we have enough housing? So there are still opportunities, especially if you're looking at our demographic profile. There are other pieces of statistics that it's because of time I won't share, but if you look at disposable incomes, for example, the savings rates, they speak volumes for us as a country. And those are statistics that are very key when we're making decisions on real estate. Now, moving on, given that, I just wanted to give you a snapshot on where we are on a sectoral basis. And sectoral, I mean the sectors. The real estate has several sectors, so I will just concentrate on about 6 or thereabouts. There are others that I'll probably just touch on in passing. But let me just give you a very broad overview. A lot of this information I'm giving it in a summarized form. There's a lot to be shared in each of these. So what we've seen is, especially the office sector in Kenya currently, it's what we say, it's in a significant oversupply state. We're talking about 7 million plus square feet of space, which has no takers. It's been exacerbated by COVID, and that it's a sector that will not recover. To recover it actually needs up to about 2025 to start seeing this sector being as vibrant as it was prior to 2019. It's mature in Nairobi, and a lot of new office, unless it's really targeted to a particular tenant who's come and it's purpose built, saying, I want these respects. It's a sector that definitely I'm not advising my clients to get into. The other thing we see is really that the yields have been compressed. They're actually trending down. We've been talking about 8 to 10%. There's a time they were actually 11, 12%, but that has been trending down. COVID has not helped deals because of vacancies, significant vacancies, work from home, and all of that. We're seeing that trending down. And now, the situation that will bear on the other side, on the counties have a severe shortage of office buildings. And it's one of those areas that I'm saying there is actually an opportunity for any developer that can play in that space of between 2,000 to 4,000 square meters of space. That is the leasable space. I will not go beyond that because, again, you have to manage risks. Something else we'll see, especially with counties, that the land component is not as priced as we expect to see, as you see in Nairobi. So you're actually able to build something decent without necessarily putting in a lot of money on land. So the opportunities across the counties, you're looking at Meru, you're looking at Nyeri, you're looking at Machakos, right here, Kakamega, Kisii, all these counties actually have opportunities for office buildings. And let me just surprise you. The rents that you go, if you go to Meru or to Machakos today, the rent per square foot for office is as much as you paying in Nairobi. No difference at all. But if you're looking at the land price per acre, Machakos in some good location, Meru, probably 10, 15 million shillings. You probably get an acre where you can build an office park. In Nairobi, you need 300 million going to 400 million for land component. So it makes it a bit prohibitive, whereas opportunities out there, but there are very few developers actually looking at opportunities outside Nairobi. Let me quickly go to now the retail sector. I've told you there's a lot of information. I think all this can be covered on its own as a webinar, but I have quite a bit of content that I just wanted to put out there. So I have my eye on the clock. Now, retail, again, this is a very mature sector, especially in Nairobi. In some other counties, if you're looking at Eldoret, perhaps Kisumu, Mombasa, there's a bit of maturity, but the other counties that have nothing, and these are rising counties. If you look Northern Kenya, for example, or parts of Eastern Kenya, there is really nothing that is being offered in retail, as it were. And there are still opportunities there in those small counties, but these are for small, very targeted centers. And these are centers, we say, with the retail, as happens with any other form of real estate, I want to actually be sure there is market before I get in. So we always guide our developers or our clients to actually pre-let space first. Go out there, determine there is actual demand the demand is actually expressed by the tenants. So they will write expressing demand, and then you can go ahead and build. So for the retail sector, especially within the counties, there's quite a bit of demand pent up. But I think a lot of the developers that you'll find in the market today are so scared because of what has happened in Nairobi, where we're finding occupancy that average 75%, some are doing below 40%. Some malls, I will not name those, but you know, because when you walk, you can see that. But then, so that sort of gives them fear, and they almost want to step back. Whereas there is actually opportunities within those in what we call neighborhood or strip malls, very small. I'll give you an example. Those who travel towards Kisumu, you've seen there's a small mall that is called Safari Center that has been opened just before the turn of to Naivasha. A small, about 1,800 square meters with Naivas as the anchor tenant, and it's fully let. Now, that mall, it's not expensive to build, but it has very good demand because it's servicing a real need, a real demand. So there's opportunities in such sectors, but a lot of, I mean, given the risky nature of the retail sector, a lot of developers are not looking at this sector. The other thing you've seen in the retail, especially in the recent past, is that we have tenants closing. We have a very small cohort of tenants. The tenants you see at Westgate, you see them at Sarit, you see them at Garden City, for example. So it's very small cohort. It's not growing. You're not attracting new tenants as you would expect. Again, a matter of macroeconomics. And given what is happening in the market, finding tenants actually closing. So I was looking, like, for example, Zucchini just closed at Garden City. I think I was there the other day and I found they've actually closed the shop. They had downsized, then finally they have closed. And there is a lot of closures that are happening across the malls from these tenants who are choosing to consolidate. So that is something that we're seeing on the retail. Let me speak on a sector that I think a lot of us know, residential. And residential, what we've seen, especially in Nairobi, is that land prices have put a lot of pressure. It's actually quite severe on this sector, such that over time, and I'll show you on a subsequent slide, you find that what has happened because of land pricing, developers have had to react to that by building more. So increasing densities. Some of the densities then we're building are such that you're not able to really afford, provide any other sort of amenities. The units are smaller. There are no amenities. In terms of lighting, it's poor. In terms of ventilation, it's poor. So this is happening quite a lot. And we're starting to see developers are actually providing, and that is what is in demand as well in the market, largely either studios, 1 to 3 bedroom units, especially apartments, and they are small. We're really talking about a studio of as small as 12 to 16 square meters, and then we'll be looking at 1 to 3 bedrooms, which will range in size between 40 or even smaller for 1 bedroom, but 40 to about 120 square meters, 120, 130. So that's where the market is. Half of, in 2010, 2009, 2010, would provide a 3-bedroom unit of about 220 square meters. Today, no developer will be providing that if he's not charging, paying, or if he's not charging that $1 million shillings for the same. So we started seeing that units becoming smaller and smaller. The same even for townhouses outside the central suburbs of Nairobi, where you go now to Roiro, you go to Kitengela and Ngong, you have townhouses. But again, these townhouses in terms of sizing, we're really talking about 110 to about 150 square meters, again, between 3 and 4 bedroom units, and targeted pricing at between 8.5 and 15 million shillings. That's where the market for residential is. Something that is coming out in the market currently, developers would put out apartments or build these units and quickly sell them out. Now it's taking long. We're seeing a typical development of about 50 units, taking as much as 24 as much as 24 months to sell. So in the past, that would actually probably even pre-sell. We used to pre-sell those developments. Today, it's almost impossible for a lot of developers, say for very, very few who've established some sort of credibility, especially with the investors, to be able to pre-sell a development. People don't trust residential developers in this city across, and it's because of what's been happening, either delays or projects which are abandoned, and then you lose your deposit. So people are actually quite scared around this. That an interesting component of the residential market is the rental market. There doesn't seem to be enough rental units in Nairobi, and this is severe across actually the city. I'm seeing some of the developers I work with building rental units, and those are snapped in, especially this range, and I'm putting that range very deliberately, between 15 and 45,000 shillings per month. On the rental, those units seem to be snapped almost immediately. Some of them actually during construction, you find that they have already been booked. And I'm seeing, given the numbers that we're seeing, especially on the demographic side, people coming into the work, the workforce and all that, young people transition from universities, there will still be a lot of demand, and it's not just in Nairobi, it's across the country. Another piece of statistics that will surprise you is that the rentals across the country have actually more like collapsed to a very narrow range. So if you're looking at rentals in Embu, for example, or Kisii for a 2-bedroom, it will be very likely comparable to what you'll be paying for in Kitengela for a 2-bedroom. It will be the same you'll probably pay for in Ngong. So that you're finding across the country, whether you're talking about Lodwar or wherever, so the rentals have collapsed to that very, very narrow range. And for survey developers, then the opportunities within the counties are actually good opportunities to chase, because again, land pricing, get an eighth of an acre, do your 20 something units there. The land is about 1.5 million, give compared to maybe 20 million in Kasarani if you were to buy land in Kasarani. So counties give that opportunity, and I think I'll show you later on I'll speak about those opportunities that are rising across a little bit later. Now, the fourth sector I wanted to speak about and that we know is the industrial sector. And the industrial sector is it's trade, because we know these warehouses that we've been seeing across for many years, these traditional warehouses. I was surprised with this, one of the sectors that has been underinvested, and it has actually attracted a lot of private equity money currently with the likes of African Logistics Partners, Actis, a few others that are coming out of the international space, looking at this market. If you look at Tatu City, for example, what has happened in Tatu City is that Tatu City, the industrial component took off, and there's so much demand for that. Purpose-built industrial parks, and that has actually activated the entirety of Tatu City, especially the housing component has been activated once the industrial component took off. Now, what happens with our existing industrial center, because industrial, especially sophisticated clients and the users are moving outside to the periphery. So we're finding they're going to the river, they're going all the way as far as Kilifi on Waiyaki Way, they're going to Tatu, the Northlands. So those are the zones that we're finding sophisticated industrial users going to. So what happens with our existing industrial center? Part of it is actually being replaced, especially with manufacturing. And that's something, it's a substitution that is taking place. That we I expect in another 10 years, we'll start seeing a lot of residential developments actually coming into play or being built within the existing industrial center. We expect to provide about about 5 million square feet of new space by 2025 in this space. The demand has been very high. By 2025, given what's happening with the economy, which is not growing as fast, and there's, I'm not too sure that we'll be able to absorb all this space. So in as much as I'm excited, I'm actually very cautious, even as I advise developers to look at this sector. You're looking at it largely on what we call pre-lease basis. It's a sector that has been put under pressure largely by e-commerce. But I have seen what is happening is that you have e-commerce also utilizing some of these spaces, especially as consolidation centers. So we find Jumia as actually areas where they are consolidating, or they are receiving their goods and they are holding them before they transmit. So in as much as, yes, we're saying e-commerce is really putting pressure on this, it's not as much, really, especially given what we're seeing in the market. Another sector that has been impacted heavily by COVID, industrial, surprisingly, that COVID actually did very well in the last 2-3 years. However, we can't say the same for hospitality sector, where we have hotels, serviced apartments, and such. Now, the hospitality sector actually got hit by COVID, especially the very first months, where you find, if you remember, even reading in the papers, that like Ransom in Upper Hill actually closed their doors. They are back, they are open now, but they closed because there was no effective demand. On the other side, what happened, and this is a global phenomenon, is that serviced apartments actually got full. They filled up. In Nairobi, in South Africa, we name it, they actually filled up because people started, especially people who are staying here for a little longer, even if you're here for a week, you prefer to be in your own space, and serviced apartments actually gained prominence. Well, serviced apartments have still continued to do well, even previously, especially for long stays, given that you get a little bit more space and all that. Given going forward, and this is a phenomenon we're seeing globally, is that hotels are actually asking for a portion of serviced apartments within, to co-development. So you have the traditional hotel rooms, but there is a co-development of serviced apartments just to cushion themselves, given what they have seen. If you look at Marriott, which is at GTC, the Global Trade Center, which is expected to be opening soon, Marriott has a component of serviced apartments. Same case with Movenpick in Westlands. Same case with Ransom Blue at the Arboretum. So we see the service component actually did very, very well. Now, there are many keys, and let me speak up, not put it in the notes, but there are so many keys which were under construction. Some of them are stored, especially for hotels in Nairobi. We're talking about over 5,000 keys actually in the pipeline. So there is a lot of space which is under delivery, and a lot of these developers are more or less taken about, a foot backwards and said, let's look at the market and give ourselves some time and see what happens here. Serviced apartments, a lot of demand. This development that I'm pointing down there is one of the development I worked on. It's owned by Britam. It's actually operated by an international operator called Ascot from Singapore. They opened in March, and by June, end of June, they had hit occupancies of 69%. And it's a big development. We're talking about 162 rooms, or rather, not rooms, it's as such, because it's 1- and 2-bedroom apartments. So you have a take up about 69% of our 162 apartments in 3 months post-opening. It just shows there's so much pent-up demand for this class of real estate. And we started to see developers actually looking at this. Surprisingly, this is across the country. So the account is like Eldoret, where to do well, the Kisumu, perhaps some of the eastern counties, that serviced apartments would do quite well. Let me go to another sector that is rising, what we call purpose-built student accommodation. purpose-built because it's student accommodation that is built ground up. You've seen what Econ has done with Kwetu, and the occupancies are actually on average about 90%, despite the number of actual developments are bringing on stream in the market. Because there's so much demand. We have actually about 1 million students in the universities and colleges in Kenya currently. And you have across the universities, in terms of just rooms available, we don't have more than 200,000 rooms to service that population. So you'll find, and it's a population that is growing. So you'll find that there will be actual demand from students, especially for what we call purpose-built, not the traditional apartments, which people are converting. This will actually build for with students in mind. You give them the amenities they need, and there's so much demand across the city. And actually across the counties where there are universities and there are colleges. There are ways to actually build this, even to make it cheaper, and you don't have to go to the extent of the levels of Kwetu. There are ways to do this because they are largely small studio units, 6 to 18 square meters. And if you look at the 18 square meter within Kwetu, for example, they are renting that at 34,000 shillings. And those are the units that actually are snapped up. Immediately, they put them out in the market, they are taken up, surprisingly. So there is a lot and quite some good deals. It's nascent. I see it as a growth sector, given where we are as a country and given all these colleges that we see that the president yesterday was giving charters to. So let me quickly now talk about the whole issue, because that was I was just giving you a snapshot, very high level, not gone into so much detail. But let me also give you now a quick snapshot of land. And what I was asking is, really, there's this land question that we have in Kenya. And we almost all the Kenyans that I know, save for now, the millennials, the surprising thing, millennials, the younger generation under 30, a lot of them are not buying land. They're actually buying apartments, they're buying yielding assets, not land, that the way we used to do it in my generation and the older generation. But what we've seen, and I'll use data from Asconsult, is that land has accelerated in terms of just the land values. Since 2007, we're almost saying 10 times, and 10 times is actually average. What Asconsult has done is to average out, especially what we call the Nairobi 14 suburbs. And these are suburbs outside the core Nairobi. So we're talking about Kitengela, Thika, Ruiru, Ngong, all that. About 10 times up since 2007. Core Nairobi, the suburbs, the inner city suburbs, and these are now your typical Westlands, Kilimani, South B, South C, and such, they have gone up about 6 times since 2007. Now, what has happened is, as I told you earlier, is that this land pricing has a significant impact, especially on housing. It has impacted the other sectors definitely, because even for offices, remember what we call total development cost as a significant, land has a significant impact to that. From my experience, the moment land goes beyond 20% of the total development budget you have, if it goes beyond 20% as an investor, you will not make money. It's a rule of thumb that especially in this Kenya, where given where the rents are, when I'm doing a quick back of the envelope analysis, if I see, given this development, land is taking about 20+% in terms of just a component, I almost always tell the developer, don't even bother looking at this, because it will not give you a good return or measured either by yield or by IRR. So, but that's where we are. So it has impacted housing especially, and I'll talk about housing. In 2007, I was practicing as an architect here, and we did quite a number of developments in Kilimani, Kileleshwa, and such. Land then per acre was going for about 30 million shillings or thereabouts. It was 30 to 40 million shillings in Kilimani. And would do about, give or take, anything between 24 and 36 units. That was a very sweet trade, because then you look at the land attribution per unit, and it's just like 1 million shillings. And you sell the unit at 7-8 million, and the developer actually makes some money. Now, that's not the case anymore. By 2012, we've seen land going to as much as 160 million shillings to about 200 or thereabouts per acre, the same locations, and it can grow by 5 times. It was, within a period of really 5-6 years, gone up by about 5 times. Now, developers responded to that by building anything between 48 and 60 units per acre. Again, just to break that land pricing to low and distribute it across many units. So there now we find still the attribution of land pricing moved from 1 million shillings to about 4 million shillings by 2012. And now the other reaction that I saw developers, of course, the way they reacted is reducing the sizes of those units. So you have many units, you reduce their sizes, you go higher, because you have to react to this one major component of land. Now, today, as we speak in 2022, I think land, as I've indicated, is gone up by about 10 times across on average. And developers have reacted by really building more units. So they're going now to 15 floors. You're covering the entire site. So if you have an acre, you're building this up to even 160 units, and there's literally no green space. It's a concrete jungle. You're going up, spanning up 15, 16 floors. You're putting a lot of strain on infrastructure, because that infrastructure that was there in 07, still what we have today. But you still find what I call the land attribution per unit, it's still around that 4 million shillings. So when developers will still now put in all these other costs to build up the development budget, you find that it will come per unit to anything up to about 10 million shillings because they need to put land pricing to under 20%. So you're finding they're delivering a unit at 10 million, and now they have to make a margin, and that's how you find units in Kilimani, in Kileleshwa, who still, despite the fact they are small 2-bedroom units, they're still being delivered and being sold at 13, 14, 15 million shillings, because a developer still has to make money. So that is one side of the equation. And this is making a lot of developments by day unviable. There is a way people have reacted to that. I think I'll show you as we go ahead, one of the other slides, the reaction to that we're seeing developers are taking. But something that has also happened is in the last 5-6 years, I think we saw the craze that was there in our minds on buying land all over the city, all over the suburbs, that has sort of died. And it's because people are becoming a bit more aware that I will go out to Kitengela, not even Kitengela, let me put it, to Isinya. So you drive about 45 kilometers from Nairobi to Isinya, then from Isinya, the main Tamanga Road, to get in another 10 kilometers to just go buy a nave at $500,000. And for a lot of people, the question that comes into mind is, how soon will development actually catch up? So people are actually seeing that you bought land in 2010 in those locations. It's appreciated marginally, number one. Number two is that you don't have people building. So you still own land out there, and it's not appreciating, and it's not, it's a struggle even to dispose it. So that sort of seems to actually be dying off. We're seeing a lot of advertisements, but a lot of the land that is being sold, it's not moving. If it's within the inner city, Nairobi, especially what's happening with Itigoni down to Roiro, there we're seeing a lot of the land is actually moving because people are able to quickly build. Outside that, you are Isinya, way past Gong and all that has sort of toned down. And the other thing that has happened is because of really literacy, financial literacy that is percolating slowly in the populace, people are asking that question and they're looking at, the alternatives. They're saying, I would rather invest my money wherever, whether in money markets or in bonds, government bonds, rather than put it in this land that will probably take forever to appreciate. So that's a land question. There is a lot to be said about this. We could speak about land for long, but let me leave it there for now. Now, let me go to the next question that is very key. What I'm calling the housing dilemma in this country. I talked about residential and I've talked about what's happening with the land, given where we are, because the land has put pressure on this. And we have this big agenda that the government had of Big Four to deliver 500,000 units by 2022. What has been delivered is actually countable, the very, very few units, despite the fact the government has made land available, has extended some tax breaks and all that to developers, has indicated it will probably take up some infrastructural bits, or no, how soon that would have been done, I'm not sure. But we've still seen nothing moving in that space. And when I was considering this, the whole housing challenge, despite the fact that we require a lot of housing, there are so many factors, and all of them, I think, even talking to developers, and because I engage with them quite often, they're my clients. There are so many factors that seems to be coming out there. And when I put this graphic together, I was looking at all these and saying, no, these developers are talking about land prices. Land prices influence the number of units you need to build. That means you might, if you go higher, and so assuming you're building in Kileleshwa, so you have to go to 15 floors, you have to build 160 units. There are no amenities, there are no green areas, there are no areas for kids to play, perhaps, all this, and you might have to throw them as pattern here and there. But then that affects other components. It actually affects how quickly those units are marketed and absorbed by the market. It will affect the price appreciation, because if you can't sell them quickly, then you find price is actually affected. In some instances, we've seen developers actually even dropping prices beyond what they are listed initially, just to try and sell. We've seen developers offering a 5-year plan, zero deposit, pay over 5 years. Some have actually gone as much as to 8 years. And when people now pick that in the market and they see you giving me 8 years, they look, it's a perception issue. And the moment people perceive that you're struggling, you're not doing well as a developer, again, they tend to keep off. And so all these are actually coming into play. Now, when that happens, you find now banks themselves look at you and they're like, we will not fund you. You're struggling first to raise equity through, of course, pre-sales and sales. But then go out there, the banks themselves are saying, we'll not fund you. And if we have to fund you, we determine that we are a risky customer. In an environment where we were capped, developers started losing funding, really. The banks wouldn't fund them because they were considered high risk. So we're looking at all these factors, and it's a big challenge, especially for us. And it's one of those things I say it's a dilemma, it's a conundrum, and there are no quick answers. We've seen a lot of substitution coming. Somebody would have bought an apartment in Kilimani, for example, who could afford it. But we're asking, I'm buying an apartment in Kilimani on an acre. I am one among 150 other households. The amount of money I'm putting here would build me a housing wherever, in Syokimau or in Kitengela. It doesn't matter whether you take 2 hours to get into work, but that substitution, it's very strong in this market. So this actually is affecting that housing space. And I've seen some of the responses that developers have had is, you have a developer like Savo, for example, who's just looked at the studio space, built small units. He is involved in the entire ecosystem, the whole value chain. So he is his own designer and he will do the construction himself through his own company. So supply. So he is able to cut a lot of costs. And that way he's able to deliver smaller units, but at prices that people will be like, okay, I'll take. And the young people actually buy those units, lease them to the market and probably get a small return. So it's a big dilemma, but we need to tackle it as a country. My focus, I think, and this is something I've shared even with government, especially in forums, where I've said government's own preoccupation with houses for sale would not fly in this market. In actual fact, we need to look at the rental component and the rental side. Now, I will tell you, in the rental space, developers are able actually to deliver units that will offer you anything between 8 and 15% if you're a developer. I've seen even slightly higher in some of them than the suburbs in Nairobi. So that rental space, if it's institutionalized, and I'm glad I can say that I know a few institutions that are coming looking at that space in Kenya. There's International Housing Solutions from South Africa, which has raised a fund that is targeted into the rental space in Nairobi, offering decent rental housing for people in Nairobi. A few others, Fusion Capital and such. So institutions are starting to look at this market. You'll have insurance companies, pension schemes are slightly behind the curve. But I think for us, our solution to the housing challenge is really rental housing, but it's rental housing which people can afford. And it's across the country because that need is there. So I wanted to put it there and just discuss really the issues that are arising when I look at the whole government Agenda 4 housing plan and when I look at what's happening in that space. Now, you'll ask me where I see opportunities. You'll have seen something that has come up. I've talked about high density residential, and that's one of the several projects that are put there. And you can see they're actually selling their units to give you as a buyer an 8% return if you rent it out. That means as a developer, if he was to rent it out at his cost, he would probably double that in terms of just the rental yield. High density resi, but done well with the amenities and everything else. I'm thinking that is one of the areas that any developer can actually focus on. Resi in Kenya is and will for the foreseeable future be very, very, very high demand. Definitely, there are new technologies that are coming in that we could utilize. We've started seeing that coming into the market. I'll show you part of it, I think, in one of the slides, one of the very last slides. But the target market is where prices are between 1 million shillings, maybe for a studio, all the way to 8 million shillings. If you, within that market category, there is significant demand in this market. And the rental, you look focusing at between 6,000 shillings and 45,000. Really, those are the brackets that I'll give. Something else, another area, because of the response, people are responding to this land question by leasing land. So we're starting seeing a lot of survey developers negotiating with landowners who can't sell the land because it's too pricey. And then remember, they're anchored. There's this anchoring buyers that anchors people to a figure. So you are told your neighbor sold land at 300 million. You actually think your acre is also valued at 300 million. So if somebody offers you 200 million, you'll never sell. Despite the fact you'll not probably get that 300, you'll probably be willing to wait for 10, 15 years to just get that 300 million because inflationary pressures will definitely take that land to those sort of values. So you wait and where you'd have taken money and invested elsewhere, you don't. It happens. It's a bias. It's anchored to a price, and you almost feel, because I own this asset, that you are endowed to this asset. It's valuable more. It's worth more because I own it rather than somebody else owning it. So what are the response that you've seen is developers actually leasing that land. So they'll give you in Kilimani acres, an acre is being leased at between 200 and 300,000 shillings a month. And developers are now putting up these small scale, really, neighborhood centers, which have become very, very popular. It's a natural response, and they have eaten into the traditional malls. So you lease the land, so don't feel the land component is actually nothing for you. It's an operational cost, and it doesn't count towards the yield. But to build these small centers, you've seen Rafter Road, for example, with what has happened with at Cafe, at Rafter Square. There's a lot in Kilimani that has happened. I think what comes into mind very quickly will be where CJ's is located just after Yaya Center. Again, within a petrol station setup, but actually developers are making good returns from those units. Naivas, Quickmart, where they are building some of these small retail centers, again on leased land. So we find Naivas or like Kamete Road or in Roysambo. You have Quickmart right there, doing quite well. These centers are doing well and just paying rent on the ground rent to the owner. The other one, and I think I was speaking to this, is as I spoke, it's PBSA that I told you, purpose-built student accommodation across the country, across some of these colleges, wherever they are, because they are taking a lot of students. And there is increasing demand for actually decent housing for students. Students, it's parents who pay. I mean, many times you want your child or your son or daughter to be housed in good accommodation. So this is a growth sector for the foreseeable future, and it's across the country. It doesn't require heavy capital investment. Again, I'm putting this because I know I'm not looking at things that will be costing you billions. It's actually relatively, some of these are relatively cheap to execute even for an entry-level employee. Counties offer a lot of opportunities across most of the sectors I've spoken about. They just need somebody to actually go there and look at what is happening within the greater, within the context of especially the urban centers that they have, and see where the development is going, where roads are planned to be built and all that. So there are opportunities in housing, there are opportunities in shopping, those retail centers, there are opportunities in student accommodation, there are opportunities actually in housing, in studios, in all that. So that opportunity exists in counties across the country, and it's actually most of the towns. Something else that I've probably, as I come to a close, that I have not put here, it's investments in schools. Now, those who are around actually seeing what's happening, that the existing schools are under so much pressure. The populations are so high. You have so many students in schools that to have classes now accommodating 50. You have schools which have increased streams, but that is not helping. So schools, it's a significant area of investment. Of course, it's a little bit more risky because it requires an operator. An operator is the person who will be running the school itself. But there is a partnership which can be structured where you have the operator with, as an operator, partnering with somebody to supply real estate, the real estate component, owner of the property. And this is across the country. It will only get worse because of really looking at our demographic profile with kids still being born. That is an area that requires significant investments. Later on, there are other areas like hospitals and all that, but I really want to speak to that because there is a lot more in terms of data and all that is out there in those areas. Now, as I close, because I'm looking at my time, it's at 4, so we are almost exhausting the time I was given. As I close, I have been hearing a lot on alternative building technologies, and I've been asked this question many times. Is it cheaper to deploy some of it? And at the outset, I would say most of these alternative technologies are actually not cheaper to use, but they save you time. So what could be delivered in a year could be delivered in 3 months if using alternative technologies. Now, the alternative technologies that you've seen in this market that are coming in, we've seen what we call EPS, the traditional polystyrene that is used to package bins has been used for actually construction purposes. Of course, it goes through some industrial processes, structural components are added to make it firm and strong. But I've used EPS before on a project. My experience is that it will save you costs if you use it for slabs. So if you put it as a slab element or a staircase element, it will actually save you cost, but not for walls. I've seen people actually going as much to the extent of building and using it on walls, but on walls it ends up even being more expensive than stone. Slightly faster to deliver than traditional methods. Of course, all of these alternatives, they require trained technicians to handle. So that's EPS. There is the other component, which is concrete. And apparently concrete in this market has not really been looked at as an alternative. We so used to stone and mortar that we don't realize we can actually build with concrete. Now, surprisingly, and I'll surprise you, concrete, especially now, it can be cheaper. It depends if it's designed well and it's specified well. It can actually be cheaper to use concrete, poured concrete in situ, what we call in situ, pour it in place, than your traditional Darugo stones and all that. It is definitely faster. It will require special formwork, and especially for repetitive work, what we call modular jobs, it's very cheap to use concrete. And we're seeing this, especially if you like these low cost or affordable housing projects the government has, a few developers have put up. They have actually used this concrete, and it comes in tied to a system, a formwork system. Will be aluminium formwork. There are some we call tunnel formworks. A tunnel has not been used here, but I know developers want to introduce it in this market. So, and all this actually save time and save cost. Something else that I've seen and people are seeing and asking questions around is whether to use pure steel for construction, light gauge steel, because it's very light gauge. Now, light gauge steel, especially given the prices of steel over time internationally, it's proven to be slightly more expensive to use. It's faster, but it's more expensive again to deploy as a construction material fully. Let me talk about something that you've seen, a fad that is, actually, let me call it a fad, because everywhere across the country, you're seeing this containers, container housing, and people deploying containers all over. I would surprise you, container housing is actually more expensive than even the traditional housing. I would rather build with stone than build with a container. Containers add up over time. When you put all the costs in the components in, it's actually more expensive, because we buy the container, a small container, a studio size, which is 14 square meters, the small one, the 20 feet container, at say 300,000. You need to fabricate it, you need to cut, you need to do the finishes, you need to put in fittings. By the time we're building that, a 14 square meter studio, I'll probably put it out. If I was building it myself, I'll probably use that 300,000 that I would use to buy the container to actually build that studio. So it's fast because they're fabricated out there and we just need to carry them, but they're a lot more expensive. People are using them largely again for shops, especially on these leased parcels of land. I think it's because it's easier to dismantle and move. So there are other reasons why people are using containers, despite the fact that they are not cheaper to utilize. The other one is 3D printing. I know Lafarge, the owners of Baburi, have introduced this. They have printed actually even a school in Malawi and all that. So it's a new technology where using either concrete or a few other materials, polyesters and all that. Actually, they are proprietary materials that are being used to print. You can print a typical 2-bedroom house in 2-3 days because we're using large-scale printers. I see this as a rising technology where you pair it with concrete is actually going forward to start seeing units delivered pretty cheaply because you save on labor costs and such. And it is so precise. When it prints, you just come and paint and you're done. So we'll be seeing a lot of this, especially now when it becomes land scale. In another 10 years, I think we'll be seeing a lot of houses being printed in situ in this country and elsewhere. So it's a technology to actually keep an eye on. Another technology that I know a lot of you have seen is what we call beam and block. It's a natural reaction again to building prices because these are what we call pre-stressed or precast concrete members. So you have a beam which is cast out in a factory, and we introduce what we call stresses to make the concrete not bend or even so that it's also able to take the loads. That is done out there in the factory. Then you come and it's actually placed on a building. Now, I've not used it because really fairly recent. It's an old technology, but it's fairly recent in terms of usage in the local market. But I'm looking at the pricing per square meter, comparing it to traditional. It can actually end up being slightly cheaper, but you need to be very careful where you are getting this because all random manner of people all over the place, of course, without necessarily any significant standards and oversight, are doing this now because they have seen it's a business opportunity. So we'll go to an established firm where I can even look at the engineering results in terms of load bearing and all that. But I will be careful where I buy this, but I can see a lot of people actually adopting this because again, it shortens time and it has the potential to actually cut costs slightly. All right. I wanted to add there. I just wanted to show you to add with this picture. This is the Safari Center, right as you go down to Naivasha on one left. It's opened with Naivas as an anchor. And this is a sort of response that we're seeing what I was talking about strip malls. But you have to be very careful in picking a location. They are not very expensive to build, but you don't go for many tenants. So you have like here about 15, 16 tenants fully leased by the time it's open and operating quite well because it has a very good draw in terms of footfalls and all that. So I wanted to add with that because I can see we'll be seeing a lot of this going forward across the country. Thank you. For the next few minutes, I'll probably now take questions. So I'll go back to Brian.
Thank you. Thank you very much, Raphael, for that empowering presentation. Many members have appreciated from the comments you're seeing coming into the chat box. Great presentation. You should offer home ownership classes for non-engineering clients. So a lot of people, a lot of members are really appreciating the insights and the great presentation that you have shared with us. Thank you very much. We'll go straight away to the question and answer session. I think several questions are coming in from the members. First question, clarification on the decision-making process in relation to the price of the land and the value of the investment. This is where you mentioned if the value of the land is at 20%, maybe you can clarify on that on the decision-making process based on the price of the land and the value of the investment.
Okay, thank you, Brian. Yeah, so what I meant here is for investment purposes, and investment is where you're looking for a rental return, perhaps, or you're looking even to sell. My experience and the experience of many real estate, the developers and players in the market is such that if I look and build up the development budget, and the development budget is made up of many components. So it has the actual construction costs, it has a component of professional fees, statutory costs, marketing costs, these soft costs and all that. But then there's a component of land pricing. All that, when you sum that, makes your development budget. Now, if you look at the land component, if your development budget, for argument's sake, is at R1 million, but the land component is at 200,000 and above, that is about 20%. More often than not, if you run your numbers, given the environment where we are today, the rental space, is that you'll find it will not give you a return that is competitive enough to compensate for the risk that you've taken in that development space. So for return purposes, for investment purposes, that's just a rule of thumb to very quickly look at, such that you either have to build more. So within, of course, planning limitations, do you build more, do you build more, do you densify, or do you go for cheaper land? So there are decisions to be made around there. But the other thing is, this might not hold for residential houses, especially in our market. If you, for argument's sake, if you go to Karen today or Ruda, and you're buying half an acre in Ruda for maybe 45-50 million shillings, you might spend as much as another 50 million, if not more. Sometimes it's more, definitely, but we might spend as much as that 50 million to build a house in that same spot. So it's, if you look at the land value and the value of the construction, more or less at 50-50. So that might not hold necessarily, especially for owner-occupier purposes. And that's why those very high-end houses, you find it's been a struggle to sell. There are very few developers actually who play in that space because of just the risk attached to those high-end houses. Because you have to actually recover your 50 million, recover the 50 million you put in construction, and still make a development gain. So for houses, that rule might not necessarily hold, but for investment purposes, it's quite important that you actually just look at that component keenly before you make a decision to invest. Thank you.
Thank you very much for that clarification. I will give you two questions at once. Do residential apartments with more than 3 floors require lifts? And what parameters do valuers use to arrive at the value of land?
Okay. So for lifts, the planning regulations in Kenya, if you go beyond 5 floors, I've seen, of course, depending where whatever your building is, there are developers who put lifts even on 2-3 floors, and because lifts are a good value and over time lifts have become relatively cheap. They used to be expensive. These days they are relatively cheap, so we find a lot of developers are actually able to afford them and plug them in. But regulations just require anything above 5 floors you have to provide a lift. Now, arriving at the value of land, there are several methods that we use in valuation. Unfortunately, in Kenya, I think what has been in use is what we call comparable sales. So I come into a neighborhood, just because somebody bought a parcel of land, it was sold for 10 million shillings, I will use that as the anchor, and I will actually say, all this land around here, if I'm valuing something which has similar attributes, characteristics, and all that, when I look at it, I'll say, this is actually valued at 10 million, or it could be, or I will adjust based on that anchor, based on that initial price, 10 million, I will adjust for a few factors, probably down ones or up ones, so that I arrive at the value. So you, comparable sales. However, for any sophisticated investor, before you buy land, I will always ask, what can I do with this piece of land? So I will run a quick financial model, and it is based on my required rate of return. So assuming I require a rate of return, an IRR of 20%, I'll ask myself, what can I build, take up that risk, probably lease or sell or whatever it is, but over a period of say 3 years or 5 years or whatever my time scale is, I'm able to get my required return. That, based on that basis, I now calculate what I call the residual value of land. The residual value is actually, it comes in as how much I'm willing to pay, how much the developer is willing to pay. Am I willing to pay 10 million for it? It is, I can see comparables is 10 million. But if this land can only support a development that if it meets my required rate of return, the max I can pay is 5 million. So for me as a survey developer, then I'll tell the owner, I will not give you a 10 million, I'll give you a 5 million. And it is based on a scientific methodology. Now that's the methodology that across the world is used. It's actually the traditional finance DCF, discounted cash flow methodology that we will run and arrive at scientific value of land. Thank you.
Thank you very much, Raphael. Two more of the questions that have come in, actually two of the last questions. A comment on the Airbnb prospects in Kenya. And the last question, which body regulates land selling companies and property developers? I don't know if you're able to get them. A comment on the Airbnb prospects in Kenya. Yeah. Mm-hmm. And the last one, which body regulates land selling companies and property developers in Kenya?
All right. Airbnb prospects. I'm not sure what to say about Airbnb because I know a lot of people who've converted their units into Airbnb, but I'll put it out there. Airbnb was doing well prior to 2019, 2019. There used to be some very good occupancy. 2022, what I've seen is they're all over. And the competition for that customer is actually quite high, such that now rates have collapsed and some people are going really for long without occupancies. So Airbnb is not an area I'm excited about anymore. And unless you have a fantastic location and you have amenities that you're offering amenities that your competitors not able to offer. So you are the location you are in, the amenities you have, the number of units operating, because then they will justify actually even getting somebody to professionally manage this asset. I'm not too excited about Airbnb. I've actually seen people struggle who rented at 60K or 70 in Kilimani, and for 3 months we've gone maybe with just a single night of occupancy. So it's an area that I'm not too excited about currently. Land selling, land agents actually are regulated by there is an agents board that regulates this, but a lot of them don't subscribe to this. We've seen, I mean, as happens in Kenya, where we have boards and regulatory authorities and all that, but there's very little oversight. A lot of land selling companies are not falling under the ambit of this. So agents are ideally regulated. It's actually to be an agent, a real estate agent, you have to fall under regulation, you have to be under a regulatory body, and it's the agents regulatory board based in Upper Hill, but it's still not doing as much as would be expected. Developers, again, not necessarily regulated. Developers have a body, an association called KPDA, which has been pushing to get into that space where it can actually regulate its members. And a lot of the members actually say it could be a good thing to have a regulatory body that regulates them. But the actual construction processes that they undertake then will fall under NCA, largely. So you'll have NCA regulating the activity, but not the developer. So developers just belong to these nice to have bodies, KPDS in this market. Yeah, I hope they'll actually get into some sort of regulatory framework at some point. Thank you.
Thank you very much, Mr. Raphael Muito. We have enjoyed the discourse. We have enjoyed the question and answer session. At this point, I will welcome Dr. Muriithi Ndegwa to give us the closing remarks. Karibu Edie.
Thank you very much, Raphael, and thank you very much, Brian and your team. We greatly appreciate the fact that, Raphael, you've really given us a very broad insight in the topic of today. But just before we come back and to thank you, allow me to appreciate all those who logged in today. At peak, I think I saw we are at about 80 or thereabouts. We also noted a number of first timers. So thank you very much to those who came on board for the first time. Let me remind you that we have these webinars every alternate Thursday. That means we'll skip that next Thursday and we'll have the other Thursday. And we've been doing this since way back in 2020. There are also those who logged in early. We start our discourse at exactly 3 p.m. And I noted by 3 p.m. we had about 37 people on board. So thank you very much for coming in on time so that we also finish early. And at the same time, we also want to appreciate those who raise questions. I think we often say that if somebody gives a discourse and there are no questions, then there's a problem. Either the communication was not right or maybe the topic was too difficult. And I've just seen one comment. Somebody was saying that it was more or less like they were getting some engineering insights, though they are not engineering students. So thank you for the discourse. And thank you also for the questions that you asked, those who had sent the questions earlier and those who even asked the questions during the discourse. It's appreciated that we saw a number of people, especially in the governance. I think I saw a member of our board of fellows, Justice Jamila Mohammed. Thank you for the support. And every other person who came on board, whether you are a member or in the governance area. Let me also appreciate Brian and his team. You do a lot of hard work behind the scenes. I know sourcing for speakers, taking the speakers through the dry run, it's not an easy work. And so thank you very much, Brian, and your entire team, including also those who are involved in terms of admitting members and also in terms of ensuring that everything runs smoothly. And to the speaker of the day, Mr. Raphael Muito, what do we say? Just a few comments. Great presentation. Wonderful presentation. Great presentation. I am now enlightened as a result of the presentation that we made. Extremely useful, excellently delivered. Great insights. Raphael, if I was to read all the comments, I think it would take another maybe 15 minutes, but we want to say thank you very, very much for making the topic of today such an interesting topic. You've given us a lot of insights and a lot of areas that perhaps one can consider to invest in. And so we want to say thank you very much for the preparation that you did and also for making the discussion or the discourse palatable. We were easily able to follow whether one is in engineering or not. And so thank you very much, Raphael, for that discourse. Thank you very much for the great insights that you did. And also thank you for the very insightful and informative way that you presented the topic and even the way you handled the questions. We greatly appreciate, and be sure that we are likely to call you again to come and give us a discourse on maybe on another relevant topic, depending on what the members say. To the rest of the members, we want to say thank you very much for joining us tonight. We want to wish you a very pleasant evening, and also next week, please go and vote. It's your constitutional right, and vote wisely. With that, let's all have a blessed evening, and thank you so much for being with us. We look forward to meeting you again in the next 2 weeks, and for now, God bless you. Bye-bye.